So today we're talking about mortgage default insurance. Thanks for stopping by. It's Margaret Heasters, the Mortgage Chick. So today we're going to talk about mortgage default insurance. A lot of people call it CMHC insurance. Okay, so what is it? So in Canada, there are 3 companies that handle the mortgage default insurance. Most people are familiar with CMHC, which is Canada Mortgage and Housing Corporation. We also have Genworth and Canada Guarantee. So let's talk about what it is, what it covers, who's responsible for it. So mortgage default insurance is an insurance premium that is mandatory to be paid by a borrower for anybody that has less than a 20% down payment for their house. So the borrower pays for it, but the lender actually benefits from this insurance. It is called default insurance. So in case you do default on your mortgage, the lender is paid back by CMHC or Genworth or Canada Guarantee. So the lender is protected. Now, because of that, because the lender is protected and it's a little bit less risk for them, you're going to qualify for the best rates that are out there. How much does mortgage default insurance cost? Well, it's tiered based on the amount of down payment you have. For example, if you have a 5% down payment, the mortgage default insurance premium is going to be 4% of the mortgage amount. So let's say you buy a $400,000 house, you have a 5% down payment, which is $20,000. You've got a mortgage of $380,000. You're going to be paying 4% of that, which is $15,200. Now, don't worry, you don't have to come up with the money for that. It actually gets rolled into your mortgage. So, you're not out of pocket, but yes, you do end up paying for it in the long run. Your mortgage payments are just slightly higher, but it's not an upfront cost that you have to deal with. Keep in mind that insurances are taxed. The tax on this is not rolled into your mortgage. It's actually paid when you close your house. So consider it part of your closing costs. So keep that in mind. You're paying tax on the insurance premium when you close your house. So I mentioned it was a tiered product. So let's say you've got a 10% down payment for this $400,000 house. That mortgage insurance premium drops from 4% to 3.1%. And if you've got a 15% down payment or more, just shy of 20, your mortgage default insurance premium drops to 2.8%. So you know what? You do benefit. The more money you have down, the better it is for you. Even if you've got a 15% down payment, you're still qualifying for that best rate with your lenders. Mortgage default insurance is actually portable. So when you buy your first house and you do need that insurance because you don't have the 20% down payment, you get your mortgage default insurance. Let's say in a few years, you want to move up a little bit, get a bigger house. You still don't quite have the 20% down. You don't have to repay that insurance. You can actually port that with you. It's called porting it. It's portable. Make sense? Now, if you are increasing your mortgage amount, at that point, you'll be charged a premium, but just for the top-up value, not the whole amount. So if you're increasing your new mortgage by, let's say, $60,000, you're only paying the top-up. That's $60,000 because the rest of the mortgage insurance premium's already been paid, and you're bringing that with you. Make sense? If you've got any questions, just comment down below, and I'll talk to you soon. This was a quick, easy-peasy video. If you like the video, give me a thumbs up or give Kiwi a thumbs up. Kiwi the super dog would really appreciate it. So subscribe to my channel, ring that bell. When you do that, you get notified every time I upload another video. I'll see you in the next video.